Maybe I shouldn't show you this one, but you know, fuck it. I'm gonna give you all the free information here so you will be able to understand the risk exposure, especially if you're very invested in bullish in the precious metals. So look at this. This information, again, it's not free. So make sure you keep this information for yourself. First of all, we have a table which represents the era of the silver and gold when they went up and when they went down. And then you have the peak gains percentage-wise and time of the year, of course. We also have the crash depth, which how far and how deep each of these actually pull back, which is very important considering that a lot of you are still thinking and believing that it will only go up, right? Also, we have duration. So after the crash appeared, how long did it take, right, essentially for both precious metals to recover at the closest level of support and then resistance. We have the reason, what was the trigger, and of course we have the recovery time. So first of all, let's start with the era of 1980s, which was the first time ever gold to hit $850 per ounce. So you do have to understand that the gold had a very healthy run up all the way up to 1,200%. And it took the gold 9 years between 1971 and 1980s. The pullback back then was only 65%. Only. You put 100K, right? The pullback happens. You're not only losing the gains, you also lose the principal. Sure, you're not going to be down only $35,000 because, you know, of course, likely this 65% pullback is on the top. So if it was up 20%, you can do the math yourself. It took 2 years, right, for this 65% to play out. And remember, we're talking about years when the volumes on the market were much lower. Not so many people have access. There were no broker apps. Now people can, you know, buy, trade. They can do whatever they want. Also, the global economy was smaller, which meant for the actual physical gold and silver, the demand was there, but it was not at the scale of today, right? Still, what was actually triggered this 65% crash? Well, we had rate hikes and fear of recession. Back in the days, only the old school investors were kind of buying or betting on gold and silver. Young people weren't invested, weren't interested. Why? Because it's boring, right? People are not interested in boring stuff. The recovery period, this is something that definitely want to pay very close attention. Well, from the bottom, when the market actually bottomed, it took 25 years to go back to all-time high. 25 years is absolutely mind-blowing. And considering a lot of people don't know this, and I'm sharing this with you because it takes a lot of time to pull up the information, to cross-check the data, and to structure the data in this way so you'll be able to understand, right? The second crash was during the 08-09 financial crisis. Well, this crisis was very, very different. It was not comparable to anything else because the trigger was liquidity crunch. The gains were not crazy. Back from the previous highs, the recovery of 25 years, it was up maybe 15% from the previous highs. It made new highs, but it was like 15, 12%. It was not something that will attract headlines, right? With only 15 to 20% new all-time high, the pullback was double. The pullback in 2008 of gold and silver was on average 30%. And it took much less. It took half time comparison with the first one. It only took 7 months versus the 2 years during the first crash. Again, liquidity crunch. And how long do you think it took for the gold and silver to go back to the previous highs? Well, it took them 3 years, which again, it's I would say 8 times faster than the previous crash. So it crashed faster, smaller percentage wise. It took less time to recover, but also didn't make new crazy all-time high. If the previous run up, they add up another 6,500, 1,000% to make new all-time high. The second run up, it only did another 15%, which they lost very far, and the double losses were on 30%. The third crash, of course, very important, was 1976. This was a very long, extended bull market in stocks where the earnings and the actual valuations of the companies were through the roof. And Wall Street was afraid that a lot of the PE ratios indicate bubble and not sustainable earnings speed. So a lot of them actually jump into the precious metals, but they only swing traded. They didn't buy in and hold. Their idea was, we're gonna buy over here when the market overheating. We feel that the Fed will actually hike the rates again, so it will cool off the economy, so it will deflate the bubble. Many people are blindly bullish for no reason. The problem is, like I mentioned, is that if you look back at the historical path of precious metals, economy, and the Federal Reserve policy, you will get an idea what the heck is actually coming on the market very, very soon. First of all, the people who are trading with leverage will get liquidated. They will be the one to actually trigger these forced liquidations. Second thing will happen is, of course, the Federal Reserve will come up with emergency meeting. You know what they actually did in 2022 during the banking crisis, right? They're going to come up with special meeting. What they're going to announce on the meeting? Well, we're going to improve the dollar, because the dollar is the actual sustainability of the US economy. Strong dollar supports everything. Job growth, wage growth, and wage growth will catch up with inflation, which, as you may have guessed, will increase the buying power and will increase the buying power of the US dollar. Look at this. The shock that has been seen for many, many years usually starts with around 30 to 50%. Then there is a calm period where everyone thinks the market will recover, everything will be good, everything will be fine. People, actually, some of them are buying the dip. Some of them are saying, you know, that's a buying opportunity. Go look at the precious metals bulls on X. Regardless, what happened next? There's another major plunge. And this plunge wipes out not only the dip buyers, it actually wipes out a lot of institutional investors who were staying put, but they already had such large positions with concentrated bets plus borrowed funds. So they're kind of the worst position possible, because you risk someone else's money, betting on someone else's thesis, and then in the end, when you lose, all the bankers are getting paid. Remember, the bonuses are coming regardless. They're getting also 1% from the money under management, regardless of the performance. So you understand who is actually the actual loser in any case possible. It's the individual investors, the people in the retirement funds, which fund actually invest in precious metals, right? Pension funds, these people. But let's go through the actual mechanics. So I want to make sure you guys understand step by step how this actually works, or how this actually have worked out in the past. 3 separate crises. First of all, silver hit $50 in 1980s. Okay, everyone was, woohoo, $50, unfreaking believable. I'm gonna buy a car. But in April 2011, silver effectively dropped to $49.80. But a lot of people who follow suit, all the individual investors, right, they didn't understand that this is simply a swing trade. Essentially park some cash, get some quick 3 to 4 to 5%, and then move on. That's exactly what happened. So when the hedge fund, when the Wall Streets actually pull off on these investments, they cash out. The people left holding the bag experienced 48% drop. And again, it took 20 months for this to essentially roll over, because the hedge funds, they're buying. The new quarter is coming. They're looking at the balance sheet. Are we having more exposure, less exposure? Are we long? Are we short? Do we buy some treasuries? Are we, selling some? What are we going to do? Okay, so this is the moment when you see 20 months is equivalent to basically, you understand, that's year, right? Full 4-5 quarters. A lot of people didn't catch up. They thought that this is the rally of their lifetime. The reason was, again, deflationary fears, it took 4 years for gold and silver to go back to the previous all-time highs. So understand, every time when gold and silver crashes, there is a long time to be waiting, 25 years, 3 years, 4 years. And now 2026, how many of you are ready for 2026 numbers? Here will be mostly guesses because we're still in February, right? But what we had of already, we had 100% plus gains. We had good rally coming from the last couple of months of 2025, some of it 2026. But the crash that appeared in one single day was 12%, 12 to 15% in gold and 40+% in silver in single trading session, which if you look at the table, it's very hard to see something like this in single day. If you look at the numbers, we saw that to get 60%, to get 30%, to get 40, 50% crash, it usually takes between 7 months all the way up to 2 years. But we got this crazy sell-off in only one trading day. What is this telling you, my little friend? This is telling you that the market has become much more manipulated, much more controlled by the big boys on Wall Street, and this effectively gives you lower probability of success, right? Because the bubble, as you can see, the recovery period is ongoing. It's not yet recovered, and it may not recover. Because here is the number. This is the historic data structured in a way that anyone can comprehend. Anyone can compare numbers. You don't have to have a financial or accounting background to understand numbers and to put some logic behind it, right? So you understand that the drawdown is very different. The volumes are very different. The recovery period is very, very different, right? And the most important is the trigger. Remember, the trigger is not yet happening. The margins that you see here in Fed pivot, it's a speculation because it hasn't played out yet. In May, when the new Fed chair comes in, we have to add another layer and upgrade the table because this is going to be epic. Stay safe, my friends.